Hey guys, it's Tom here from the WB Trading team, and today's video we're going to focus on market correlation, and we're going to have a look at a few different examples. One question I often get asked is how important is correlation, and it does depend to a pretty large extent on what type of strategy you're running, what time frames you're looking at, and what parts of the correlation is going to be most impactful to what you're trading. What we're going to look through here is periods, like if we zoom out on the market, have a look at long periods of correlation, both positive and negative. And then we're going to look more kind of interesting, I suppose, at short-term correlation, really focusing in on what that means. So yeah, let's get started. Just very quickly before we dive in, if you're still struggling with your trading or you'd like to know more about how mechanical edges are traded, I've put together a free video course for you that will map out and explain everything in detail, along with walking you through exactly how the mechanical rules actually work. If you'd like to watch that after this video, I'll pop a link in the description. You can click through and you can watch that straight away. So we're going to start here by looking at comparison of two currency pairs. I'm going to use EURUSD and AUD/USD, and we're going to just look at these on a 4-hour chart. And I've got a snapshot here side by side of what's happened in the month of September so far. So fairly easy to compare the overall trend and performance of these two. As we can see here, we've seen a big drop on the euro, starting up here and obviously coming down at the moment to finish down here, whereas Aussie dollar's been fairly flat. It's had a few ups and downs, but where we started the month here compared to where we are right now, it's pretty close. So long term, there's not a huge amount of correlation in here if we're looking over this month worth of period. But there are elements within here that we can see some pretty strong correlation, which is kind of suggesting the dollar is really driving the move on both these currencies. So let's have a look at a couple of these instances right now. So the first area I want to focus on is this bearish period here on the 20th on both markets, where we see those 3 consecutive 4-hour candles just dropping pretty quickly. So almost a full day's worth of trading there on both markets, and you see an almost identical setup. Let's just zoom in and have a look at that in a bit more detail here. So we can see here the 3 candles on the euro and a very similar setup here on the Aussie there. So in this instance, if we're looking at a particular approach, maybe our strategy related on trading through, say, a support or resistance zone, or a reversal based on those areas, for an example, would this be a situation where we would take both trades? And this is the question we need to look at when we're looking at correlating markets. If we're looking over a wide number of markets and we need to factor in, how much margin do we have available, how many orders or how many trades can we take at any one time, situations like this are a good reason to pay attention to the correlation, because we can avoid essentially taking a duplicate trade. So if we were going to trade this reversal, if we had a line on, say, to mark on the resistance, and say when we hit that, we're going to take the bearish trade. If it's happening at exactly the same time on these two pairs, and we would probably see this on a few other pairs related to the dollar, because it seems to be a real push down from the dollar there, we're going to want to take just one or maybe 2 of these instances, but not every one we see, because we're essentially taking the same trade on all these situations, and we're just duplicating across and eroding our margin, which we can use, hopefully, for other more unique opportunities that come along. Let's introduce a third market now, and we're going to look at the negative correlation side of things. So we've still got EURUSD here and the Aussie dollar here, and you can see we've still got this focus on the 20th to the 21st with these 3 candles, but then I'm going to add in dollar Canadian here. So essentially the reverse pair, where we see this huge bearish move on those same 3 candles, and coming off, what is, I would say, a fairly small support zone. We can discuss that in more detail, but you're still seeing the same move here. So in the same way that these two bounced off a small bit of resistance here, this bounced up from the support. So even though, visually it's not identical in the same way that these two are, we've got to be watching out for this negative correlation, because it is essentially the same market move overall. And, if we flipped it around, if we, sort of turned it upside down, you would see exactly the same setup. Obviously, the colour of the candles would be different, but in effect, hopefully you can see what I'm representing there. So even though, it might look like a different setup at first glance, because, we're taking a bullish move, this isn't the same as taking multiple bearish ones, we need to consider what are we looking at in terms of the overall market move, what currency is driving the move, and does it look similar, even though it might not be in the same direction as what we're seeing on other markets. So yeah, whereas we're expecting these markets to drop quite a bit, are we expecting this to go up, how far? And we need to factor that thought process in. And that's another way that we can avoid basically eroding our margin by taking too many of essentially a mirror trade. So just as important to look for that negative correlation as it is to look for strong positive correlation in the market. What happens now if we zoom out and look at the markets from a bit further away? You'll see as we get basically, more and more market information on the screen, you're going to see less and less strong correlation. And so you can see that here if we look back now at these three markets over the past few weeks, suddenly there isn't really a lot of strong correlation there. We can still see the individual points like that 3 candle burst we just had a look at, but overall market movement doesn't really correlate that heavily between each of these. We're on a fairly slow downward slope here on dollar Canadian. Aussie dollar has been pretty flat, and then on Euro USD you got this huge thrust candle here on the 14th that we don't see on the other markets here, and that's caused it really to drop a little bit, but overall it's been fairly flat. So as we zoom out, and obviously if you're looking more longer term in terms of your strategy approach, you're going to see less and less instances of correlation impacting what you're doing. So if we're looking at on a 4-hour chart, for example, to get in and out in the same day, just based on a quick move, then correlation is going to be absolutely vital for us to avoid taking mirror trades. But if we're looking long term, it's going to have much less of an impact. And this will be the same on any time frame. So now if we come down and use an example on the 15-minute chart, and we look back through early this week to Wednesday the 20th, and I want to focus in on this particular situation here, where we've got this thrust candle here, pretty much at exactly the same point on every market. Obviously, as we would expect, we're seeing we're seeing the same candle on both Euro and Aussie dollar, and then on dollar Canadian, we're seeing the reverse candle. So in this case, bearish, bullish. And afterwards, we're getting a fairly short-term trend here, but a fairly quick move in the market. So once more, if we're looking intraday, and if we're looking at these certain situations, again, maybe for support and resistance, maybe for these breakout or reversal type approaches, this is something we need to focus on as well, because once more, we're going to be looking at margin requirements. We're going to be looking at potential margin erosion here. And obviously, eventually, worst case scenario, leading to that margin call because we've got too many trades open. So is it viable to take this trade 3 times? If these are the markets that we're looking at as part of our portfolio, do we want to be taking the same trade essentially multiple times? And in most situations, the answer would be no. So in this case, we would look at this, and what I would usually do personally, I'd pick the market that has basically the most competitive edge for me, the lowest spreads, the least likelihood of slippage, these factors that I would bring in. For me, it would be Euro USD, and even though I saw the setup on Aussie and dollar Canadian, it would be a trade that I would avoid because I was already taking it. And so then it would give me margin free to look for other trades that wouldn't have a stronger correlation. So even on the lower time frames, it's something we need to be careful of. It's something we need to be mindful of and focus in on to really avoid getting trapped with too much margin tied up in mirror trades. So I'm hoping that's been useful in terms of how can we identify correlation first off, how important is it? And what does it actually mean when we're placing trades, and how can it negatively affect us? If you'd like to see different market sectors, correlation, outside of the currency pairs, just let me know. If that's a topic you'd be interested in, we can put together a video on that. And as always, just let me know if there's any other video topics you'd like to see us cover. But thank you all for watching, and I'll catch you on the next video.